The Bank of Canada just raised interest rates again and has thrown the Canadian housing market outlook back onto shaky ground. To this point, the Victoria, BC market has been remarkably resilient, and despite 5% interest rates, some segments of the market have actually caught fire and seen prices rise dramatically from the beginning of the year. But will the latest trends survive the latest hike, or is this the straw that finally breaks the camel's back? We're going to unpack some of what's happened on the ground over the last few months, and then talk through and project where this latest rate hike puts us as the summer months unfold. So what has the spring market taught us so far? Well, as some of you that have been following along know, I'm not too afraid to stick my neck out there and make a prediction or call based on what I'm seeing on the ground. But on this occasion, I was wrong. I thought we would see average inventory and below average demand or unit sales on a monthly basis, and we basically have seen the opposite this spring, which is well below seasonal average new listing inventory and higher than expected unit sales on a monthly basis that seems to have ramped up as we've moved from March to May. This change, especially in segments like detached homes in the core neighborhoods, means properties have gotten more competitive, we've seen more multiple offers, and prices have ratcheted higher just in the last 60 days. Let's put some of these stats into context. Although I say that the spring market demand has exceeded what my expectations were, both March and April did record the lowest unit sales that we've seen in the last 9 or 10 years, which makes sense in the interest rate environment that we're in. The problem is that in tandem with this happening, we saw new listings figures for these months also well below 5-year averages, with April having the fewest new listings for the month going back to 2003. Consequently, we've seen the absorption rate or relationship between sales to active listings steadily creep up since the beginning of the year, and prices in a way have tracked the same chart. Now, this isn't the same for all segments of the market, but looking at the median sale price of a detached home in Greater Victoria, that's climbed from below $1 million in November of 2022 all the way up to just shy of 1.2 in May of 2023. Although unit sales in detached homes and condos were both above their 10-year averages in May, there isn't quite as much upward pressure on prices in condos or townhomes for that matter as there is in detached. Part of this is the affordability factor, with a lot of homes listed below 1.5 with suites actually being more affordable on a monthly basis for those who can qualify for them than townhomes, as an example. But with that said, we have some weird things happening here and there. Like in May, we had the most condo sales above $1 million that we've ever seen in the history of our board. Nevertheless, I go back to the fact that the hottest segment of all is detached in the core, priced between, say, $950,000 to $1.5 million. How hot or competitive is that segment? Well, 36 out of 138 detached homes in the core neighborhoods sold above the asking price in March. In May, that figure rose to almost 40% of the homes listed. So 60 out of 152 homes sold above asking. Many of them were in the $950,000 to $1.5 range, but there were a few examples for homes selling in multiples, even up above $2 million. Ultimately, this is all happening because buyers are showing up and sellers are not. Why is that the case? Well, everyone's personal situation is different, but I've got a few ideas. On the seller side, I don't think there's a lot of sellers showing up because a lot of people are fixed into incredibly attractive fixed rates that we had through the pandemic, and there's no reason to want to sell or part ways with that rate. Another reason is that we've gone through this extend and pretend type situation where a lot of variable rate mortgage holders have been given the option to extend amortizations beyond the original amortization schedule that they agreed to with their bank. The third reason why is that for those 20% of Canadians that have come up for renewal so far this year, the payment shocks aren't so severe that they're having to part with their properties. Recall that in 2018 or 2019, rates were in the high 3s. So from the high 3s to the 5s, most Canadians can stomach it. And the fourth reason is that for those move-up buyers that are considering a larger loan, the expense of that is maybe making those buyers push that out a little bit further than they normally would have when they were planning to move up from a condo to a townhouse or a townhouse to a detached property. And the fifth, and probably most impactful of all of these different factors, is that in these low inventory environments, without many options, most people thinking about moving just say, you know what, I'm not seeing a lot of product that makes me excited about the prospects of moving, so I'm just gonna hang tight for a little bit longer. And the buyers are still showing up because of three main reasons in my mind. Number one is the fact that people just have to move because of their life circumstance, whether they're getting divorced or having a kid. It's just time to move for some people, and they just stomach the cost of having to do so. The second is the fact that in March, the Bank of Canada stoked this sentiment flame of people getting excited about housing again, now that they thought that the worst was now behind us, and all of these rate hikes were at an end. And the third reason is the fact that I just think there continues to be this underlying sentiment in Canadian housing that it's just going to keep rising over the long term regardless. You hear people throw around a lot of facts about immigration, lack of supply, people not building enough to keep up with the amount of people that are moving to Canada. In Vancouver, it's already been proven out that prices can go a lot higher, so it's only a matter of time before this city catches up. I mean, I find myself going there myself sometimes. I think this is an attractive place to live, and over the long term, we'll continue to see prices rise. Now enter Tiff Macklem and Company, who just unexpectedly hiked rates to the highest level we've seen in 22 years to 4.75%. Surprising most people with this move, and what felt unexpected from the Bank of Canada. Strong GDP numbers for Q1, higher than expected inflation numbers in April, a few things leading them to believe that the jobs market is still strong and consumer spending is still strong. Also some rhetoric about what other nations are doing to fight inflation. And in a lot of ways, this was a bit of a gut punch, a surprise, like I said, but maybe an intentional surprise. Tiff Macklem is telling everyone, I am not screwing around, and I'm gonna do whatever it takes to kill spending and kill inflation. So how does this affect homeowners and markets here in Victoria? Well, anyone looking to qualify, it's a lot more painful. We saw the 5-year bond yield from the Government of Canada jump another 20 basis points on this news, which means those 5-year fixed rates will get repriced higher. It's another gut punch for anyone on a true floating rate variable mortgage. You will have another slight increase in your monthly payment. And for those with a static payment variable, of course, again, we're talking about potentially getting triggered again if you're not covering interest or pushing out amortization. Overall, it softens demand with less people qualifying or even choosing to try and qualify. But I think the bigger hit here to the overall buyer sentiment in Victoria, BC, is the fact that we're back on shaky ground with the path of interest rates. And I think more people will find themselves on the sidelines and saying, you know what, I'm just gonna wait this out over the next few months and see how it plays out. Now, again, it's important to contextualize what happens historically through the summer months in Victoria and how might that affect prices over the next few months. Let's get into that now. For every month that passes as we move through the summer, we historically get less and less active listings. So even if demand continues to pull back and we see less unit sales month over month as the summer progresses, the new listings also probably track in that same direction, and the absorption rate likely remains relatively stable. Although I will say that, again, the market is pretty segmented or patchy at the moment, so probably the most support for prices will be in some of those hotly contested areas like detached in the core under 1.5, and it could get a little bit softer in high-end townhomes or entry-level investor-friendly condos. The caveat to all this is, what the heck does the Bank of Canada do next? We actually had a speech in Victoria from Paul Beaudry at the Bank of Canada today at the Victoria Chamber of Commerce that sounded a little bit hawkish.
Since we started the pause, just repeatedly we've been surprised about the strength of the labor market. Unemployment has stayed at these historical lows, had an accumulation of evidence on many fronts over time and across a whole set that tell us that inflation seems to be more sticky and it's going to be harder to get it down to that 2%. And it's that accumulation of evidence that kind of brought us to our decision yesterday. So we were first surprised on the upside from the kind of growth in the first quarter. So the national accounts came out, and we were kind of predicting more of a 2.3, and it kind of came up at 3.1. What's the big driver there is consumption. Consumption came in at 5.8% growth. That's very high growth, and it was very broad-based. Services, not surprising, with the pandemic and things, services went down, and we've kind of seen them kind of coming up. But we thought by now they'd be kind of slowly kind of easing off in terms of that kind of growth rate. And no, we didn't see that. The services just continued. Even more surprising, goods had been taking off. Like a lot of people bought a lot of goods during the pandemic and things, and we kind of thought, that would be showing, and it was kind of going down for a while. Now it's ticked back up. And it's that aspect that really kind of suggests this kind of strength in the economy.
Of course, nothing in their messaging from the press release yesterday had anything to do with them pausing or stopping from here, and they seem resolute in the idea of bringing inflation back to their 2% target. It's a mixed bag and anyone's guess at this point. I always suggest you guys get great advice. If you have any questions on how this might affect your specific scenario, feel free to reach out to me. I'll leave my contact info in the description down below. And otherwise, I'll look forward to updating you on everything that's going on in our city over the next few months.